For years, the mainstream narrative surrounding Bitcoin has been dominated by a singular, persistent criticism: its environmental impact. Headlines have routinely compared the Bitcoin network's energy consumption to that of medium-sized countries, painting a picture of a digital asset that is boiling the oceans and accelerating climate change. However, a quiet revolution has been taking place beneath the surface of the hash rate wars. Recent data published by the Bitcoin Mining Council, or BMC, indicates a pivotal shift in the industry's energy sourcing. The report highlights that the global Bitcoin mining industry is now utilizing a sustainable energy mix of 56.7%. To understand the gravity of these minutes, we first need to look at the context. For months, the market was pricing in aggressive rate cuts, anticipating that the Fed had successfully engineered a soft landing. However, the data has refused to cooperate. In the minutes released today, officials explicitly expressed concern regarding the lack of further progress toward the massive inflation objective. This is a polite way of saying that inflation is stuck. The participants noted that while inflation has eased over the past year, in recent months there has been a notable lack of further progress. Let's look at the catalyst: the United States national debt. We are currently sitting above $35 trillion in debt. The interest payments alone on this debt have now surpassed the entire U.S. defense budget. This is what economists call a debt spiral. There is mathematically no way to pay this off through taxation alone without crashing the economy. Therefore, the market expects that the Federal Reserve will eventually be forced to lower rates and print money to monetize this debt, effectively inflating it away. This expectation is the engine of the debasement trade. The supply of Bitcoin on exchanges is at multi-year lows. Long-term holders are refusing to sell, and now you have massive institutional aggregators like Morgan Stanley, BlackRock, and Fidelity creating continuous bid pressure. When you have fixed supply meeting exponential demand, the only variable that can adjust is the price. This is basic economics playing out on a global stage. However, we must remain objective. A retest of $93,000 can also invite volatility. Traders will take profits, and leveraged positions may get flushed out. But the difference this cycle is the floor. In previous cycles, corrections were deep and prolonged. In this institutional cycle, every dip is being bought up by ETF issuers who need to balance their books daily. Furthermore, we need to contextualize Morgan Stanley's move against the broader competitive landscape. They are not acting in a vacuum. They are responding to client demand and competitive pressure from rivals like BlackRock and Fidelity. The fear of missing out, or FOMO, is no longer just a retail phenomenon. It has infected the C-suites of Wall Street. If Morgan Stanley did not offer this exposure, their high-net-worth clients would simply move their capital to a firm that did. This is an arms race for assets under management, and Bitcoin has become the weapon of choice. This filing effectively opens the floodgates for their network of 15,000 advisors to start pitching Bitcoin to clients who may have zero technical knowledge of crypto but want exposure to the best-performing asset of the decade. In conclusion, as we watch Bitcoin flirt with $93,000, remember that the price is just the scoreboard. The real game is being played in the regulatory filings and boardrooms of Lower Manhattan. Morgan Stanley's integration of Bitcoin ETFs is a signal that the asset has graduated. It is no longer an experiment, it is a portfolio staple. We are likely seeing the early stages of a run to $100,000 and beyond, driven not by hype, but by structural flows of capital. As always, manage your risk, stay informed, and keep your eyes on the long term. If you found value in this deep dive, make sure to like and subscribe so you don't miss our next update on the institutional takeover of crypto.